Welcome business owners and C-level executives. Let's jump right into it. In this explainer, we're breaking down Vietnam's dense new tax regulations, specifically Decree 254 and Circular 91, and we're focusing entirely on how they impact your bottom line. Look, we know your time is incredibly valuable, and regulatory updates usually feel like navigating a maze of legal jargon, right? Well, these upcoming 2026 changes to the E-invoice system aren't just minor administrative tweaks. They represent a fundamental shift in how your business is going to handle procurement, revenue recognition, and tax compliance. So here is our executive roadmap for today. We'll start with Vietnam's E-invoice overhaul, then move on to foreign e-commerce platforms, look at some surprising e-invoice exemptions, talk about fixing e-invoice mistakes, and finally, we'll cover the new export exchange rates.
All right, Part 1, Vietnam's e-invoice overhaul. The core goal here from the Ministry of Finance is to tighten digital compliance and standardize tax data across every single business sector by 2026.
Now, honestly, reading through hundreds of pages of Vietnamese tax code like Circular 91 is nobody's idea of a good time. So we've gone ahead and translated all that dense legal jargon into pragmatic, actionable takeaways for you to pass right on to your legal and accounting teams. You really don't need to be a tax lawyer to understand this stuff. You just need to know exactly where the financial risks and the opportunities actually lie.
Moving right along to Part 2, Foreign e-commerce platforms. Let's look at how this impacts your digital procurement strategy when dealing with foreign providers.
Okay, this is a massive shift. Foreign digital platforms, we're talking your major international software providers, digital ad networks, cloud hosting services, are now forced to register and use Vietnamese e-invoices. The word voluntary is completely gone from the law. And honestly, this is fantastic news for you. Because these foreign entities now have to issue formal e-invoices, your business can finally claim those VAT deductions easily, and you get to skip the massive headache of declaring and paying foreign contractor taxes on their behalf. It is going to streamline your cross-border digital procurement so much.
But wait, there is a huge catch here. Picture this. Your staff uses a corporate credit card to buy software or run online ads. If that foreign platform hides your company details and issues a generic invoice labeled sold to consumer or bán cho người tiêu dùng in Vietnamese, you completely lose the right to claim that VAT deduction. Just like that, it becomes an invalid invoice for corporate tax purposes. So you absolutely must direct your procurement teams to aggressively demand that these platforms include your exact company name and tax ID on every single transaction.
Okay, Part 3, surprising e-invoice exemptions. It's not all extra work. The government is actually reducing the administrative burden in a few highly specific scenarios. Believe it or not, there are some huge wins for operational efficiency here. For instance, if your business leases out property, you no longer have to issue a formal e-invoice every single time rent is paid. You just need your leasing contract and a standard payment receipt. That's it. Also, if you're a tech or media company exporting digital ads, software, or films to a foreign entity, you're entirely exempt from e-invoicing those transactions. And the exact same rule applies if you're temporarily shipping fixed assets or tools overseas for processing. Pretty great, right?
But here is a critical danger zone hiding right inside your contracts. If your contract collects a true security deposit to guarantee performance, great, it's exempt from invoicing. However, if your legal team accidentally uses the phrase advanced payment or dien tam ưng, you are legally required to issue an e-invoice the exact moment that money hits your bank account. Literally, a simple vocabulary mistake in your standard contract template could trigger severe non-compliance penalties. You definitely want your legal counsel to review your deposit clauses today.
That brings us to Part 4, fixing e-invoice mistakes. Because, let's face it, your team is eventually going to make a typo.
In the digital age, you can't just sweep a typo under the rug, and you certainly can't just hit delete on a bad invoice. The tax authorities have a permanent, real-time record. Under the new law, you have to follow a rigid, step-by-step chronological sequence. First, you and the buyer have to draft a formal written agreement acknowledging the error. Only then can you issue a replacement e-invoice. And here's the kicker. That new invoice must contain the exact, verbatim statutory phrasing, replaces invoice, form, symbol, no, date. If your accounting software doesn't automatically add that exact phrase, your replacement invoice is completely invalid.
Before we get into our final update, I want you to ask yourself, how does your CFO currently calculate taxes on your exported goods? Chances are they're using a standardized accounting exchange rate or maybe a monthly average just to keep your books clean and predictable.
Which leads us perfectly into Part 5, New Export Exchange Rates. This kicks in on July 1, 2026, and it fundamentally changes the relationship between your financial accounting and your tax reporting.
This is basically the most mathematically complex part of the whole update. You can no longer use your internal accounting rate for export taxes, period. Under the new rules, you must strictly use the customs exchange rate, which is rigidly fixed to the Vietcombank Thursday closing rate for the following week. What does that mean for you? It means the revenue you report to your shareholders on your books will mathematically differ from the revenue you report to the government. It's going to create a permanent discrepancy that your CFO will have to meticulously track and manually adjust during year-end tax finalization.
So the real question I want to leave you with is this. With hidden e-commerce traps costing you VAT deductions, simple contract wording triggering immediate tax liabilities, and a completely split exchange rate system forcing your accountants to keep two sets of mental ledgers, is your executive team actually ready? This 2026 overhaul gives the government total transparency, but it requires serious, proactive adaptation on your end. Ask yourself, if an audit happened tomorrow under these new rules, how much of your revenue would actually survive the scrutiny?